Welcome. Today we're diving into the most ignored advice in modern investing, advice that comes straight from Warren Buffett himself. Despite being repeated for decades, this simple strategy is often overlooked because it's boring. But sometimes boring is exactly what works. Let's explore what Buffett actually said, why he said it, and why so few people follow it, even though it's been hiding in plain sight for years. Back in 1993, at Berkshire Hathaway's annual meeting, a young accountant asked Warren Buffett what an ordinary person should do with their savings. Buffett didn't hesitate. He said most people should put their money in a low-cost S&P 500 index fund and leave it alone. He's repeated this advice almost every year since in interviews, letters, and even in his own will, yet almost nobody follows it. Clearest version of Buffett's advice appears in his 2013 letter to Berkshire Hathaway shareholders. He told the trustee of his estate to put 10% of his wife's inheritance in short-term government bonds and 90% in a very low-cost S&P 500 index fund. He even named the fund. He wrote that this simple approach would likely outperform most investors, including professionals and institutions. Think about it. Warren Buffett, the most successful active investor in history, tells his own family not to do what he does. Instead, he recommends buying one boring fund and ignoring everything else. He believes this approach will beat almost every professional manager out there. That's a powerful endorsement for simplicity over complexity. How does Buffett recommend this? The answer is in the data. Each year, S&P Dow Jones Indices publishes the SPIVA report, which compares professional fund managers to the market itself. The results are brutal. Over 15 years, about 88% of large-cap mutual fund managers in the U.S. failed to beat their benchmark. Over 20 years, the numbers are even worse. This isn't just opinion, it's measured, published fact. These fund managers have every advantage: research teams, technology experience, and direct access to company executives. Yet 88 out of 100 still lose to a simple, low-cost index fund, and that's before taxes. After taxes, the gap is even wider. This is Buffett being humble. It's a reality that's been proven year after year. Let's meet David, a regular investor from Ohio. In 1999, he inherited $10,000 and did what most people do: he hired a financial advisor. The advisor charged 1% per year and the funds charged another 0.75%. Over 25 years, those fees added up. Last year, David calculated what he'd lost to fees, and the results were shocking. Fees don't just take money out of your account each year, they take money out of every future year that money could have grown. It's not just subtraction, it's compounding subtraction. Over decades, even a 1% annual fee can reduce your final portfolio by 25–30%. That's a third of your wealth gone just for paying for advice that often underperforms the market. If David had simply put his $10,000 into a low-cost S&P 500 index fund and made the same contributions, his account would be worth about $185,000 more today. That's a paid-off house or a decade of living expenses lost to fees. The lesson? Small percentages make a huge difference over time. So why isn't this advice more popular? It's not a conspiracy, it's about incentives. Low-cost index funds pay almost nothing to advisors. There's no commission, no recurring fee, no kickback. The strategy that works best for customers pays the industry almost nothing, so it's rarely promoted. The financial industry acts rationally. It promotes products that pay them. Complexity justifies fees. Stock picking and active management require expertise, which means recurring revenue for advisors and fund companies. Wall Street isn't lying, it's just selling what pays, and what pays is what Buffett recommends. Let's be honest, Buffett's strategy only works if you stick with it. The biggest reason people fail with index funds isn't the strategy, it's their own behavior. When markets crash, the temptation to sell is huge. Those who panic and sell at the bottom turn a winning strategy into a losing one, locking in losses and missing the recovery. Morningstar tracks the gap between what funds return and what investors actually earn. This gap, usually 1.5 to 2% per year, is caused by human behavior: buying high, selling low, and switching strategies at the worst moments. The strategy is simple, but sticking with it is psychologically tough, especially during downturns. Buffett's approach isn't intellectually hard. It's one fund, one allocation, one rule, but it's psychologically demanding. It requires you to do nothing for decades, even when doing nothing feels like financial suicide. That's the real challenge for most investors. So, how do you actually follow Buffett's advice? Step 1. Open a brokerage account with a low-cost provider like Vanguard, Fidelity, or Schwab. You can do this online in about 10 minutes. It's simple and accessible to almost everyone. Next, choose a broad index fund that tracks the S&P 500 or the total U.S. market. Look for an expense ratio under 0.1%. This ensures you're keeping costs low and maximizing your returns over time. Set up an automatic monthly contribution, even if it's a small amount. Consistency is key. Automating your investments removes emotion from the process and helps you build wealth steadily over time. Decide now that you won't sell during market downturns. Write it down, tell someone you trust, and make the commitment in advance. When markets crash, your future self will thank you for sticking to the plan. Finally, do nothing else. Don't check your balance every day. Don't switch funds or chase last year's winners. Ignore anyone who claims to have a better idea. Statistically, they don't. The best move is to stay invested and let time do the work. The uncomfortable truth in personal finance is that the answer has been known and published by the most respected investor of the last century. It's ignored not because it's hard to find, but because the industry profits from complexity. Buffett didn't whisper, he published, spoke on TV, and wrote it in plain English. Here's the final takeaway: investing isn't a competition to win. It's a system to join. When you buy a low-cost S&P 500 index fund, you stop trying to beat the market, you become the market. You own a piece of the 500 largest companies in America, and their profits flow back to you automatically year after year. You don't need to be smarter than anyone else, you don't need to predict the future or time the market, you just need to get in and stay in for decades. Buffett's instructions are public, simple, and proven. The only question is whether you'll finally listen.